Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining us is Manuj Jain. He's Head of Product and Strategies at WhiteOak Capital AMC. Welcome, Manuj.
Thank you so much.
Good to have you back with us. Now, let's start today's conversation with your column in Mutual Fund Insight December 2024 issue, our FIIs leaving India. So the $11.5 billion FII outflows that you mentioned, the figure does sound alarming at first, but as you mentioned, it's just 0.2% of India's market capitalization. So why do you think the context is overlooked, and what does it mean for investors? What should they focus on instead of just the big headline numbers?
So see, many times when we look at these large numbers, first of all, it is in billion. So yeah. I personally find it very difficult to convert into rupee mentally, but billion sounds very high number, and actually it is a very high number, and that too in dollar term. And then you compare these numbers with some pre-historical numbers. For example, during global financial crisis, FIs have withdrawn some $15-16 billion. And as we speak, they have withdrawn some $13 to $14 billion, including in the month of November and first 2-3 days of December as well. So it is very obvious. I mean, I don't have any complaint, but it is very obvious that you will compare these numbers with historical references. And another way to look at it is that right now, market has corrected only 10% from their peak. Right. I mean, in the month of November, at one point of time, markets were down by 10% from their peak. Versus during global financial crisis, when they have withdrawn some $15-16 billion, which is comparable figure, markets were down by more than 60%. So it is obvious to think about it that is there something which we are missing? Because FIs typically regarded as smart investors, so they are institutional investors, so they have some information which we don't have, and if they are withdrawing so much money, that means something big is going to happen. So let's redeem our money before more correction happens. So that is the obvious response by most of the investors. But I think in that article, we try to communicate that these numbers should be looked at in the context.
Right.
For example, in 2008, when they have withdrawn $15 billion, our market capitalization, total market capitalization of Indian equity used to be $1 trillion or $1,000 billion for easy reference. Today, as we speak, FIIs themselves have about $1 trillion invested in India. So our market cap today is about $5.5 trillion, out of which about 70 to 18% is being owned by FIIs. So we roughly about $900 to $1,000 billion is being owned by FIIs. So when they have withdrawn, let's say $15 billion in 2008, that was actually a large sum of what they have invested in India. That was used to be about 8 to 9% of their total holding in India. Right now, they themselves has about $1,000 billion, out of which they have withdrawn, let's say, $15 billion, which is like 1.5% or less of their own holding, and only 0.2 or 0.3% of our Indian holding. So yeah, these numbers should be looked at in conjunction with what is the size of the economy or size of the market at this point of time, rather looking at the absolute number.
All right. Now, so what has happened is that some sectors like defense and real estate, they have been hit hard, double-digit corrections. And while others, their healthcare, IT, they have held their ground. So what do you think is driving the split, and how should investors think about these trends when building their portfolios?
So clearly, we have seen some sector rotation, not only in last couple of months, but let's say in last 6 odd months.
Right.
And, over the many years, I have seen that if something is in momentum, and something is very famous and every investors is looking to invest in particular theme or sectors, we can say that that theme or sector, that particular stock is in momentum. And to break that momentum, if something is very, very overvalued because of the so much interest by investor community, so much flows going to that particular theme, so you typically see that theme becoming very overvalued. And to break that momentum, you need some external event. Okay, so this is the principle that if something is in momentum, you need some external force to break that momentum. So that external force, now in the hindsight we know, proved to be recent volatile events. I mean, recent events which triggered volatility. For example, in the month of June, we have election results. Then subsequently, there was some global event, then US election, then a lot of outflow by FIs. All these events have created some volatile environment, some uncertainty in the market, and that proved to be trigger for these overvalued sectors to rotate. And hence many sectors which were in momentum are now finding themselves in thick soup, and they have corrected. Like you rightly mentioned, we have seen more than double digit correction in many of these sectors, and sectors which did poorly in last 3 years, despite earning being on their side, despite they are very good sector, they are structural sector in India, but over the last 3 years they didn't do well. And now they are picking up, and they have provided some cushion, like you mentioned, healthcare, IT, private bank. In last 3 years, all these sectors were underperforming. They were laggard, but now they have started to perform well. So yes, we can clearly see sector rotation.
So now with overvalued sectors correcting, do you see opportunities for a thematic or contrarian approach now?
Yeah, definitely. So there is a set of investors who like to take thematic call or tactical call. For those investors, they should look for these opportunity, because we are talking about those investors who are basically tracking the market, tracking all the event, and basis on them they are taking some tactical call, which are the next opportunity in the thematic space they can vouch for. So yeah, clearly there is a break in momentum, and I strongly believe this has triggered to sector rotation. And the themes and sectors which did very well over the last 2-3 years, and I think I strongly believe many of these themes may not do as well in next 2 to 3 years, and people who are looking for these opportunities should reevaluate, because over the last 3 years, let's say value theme did very well. Okay, so if for some reason you are now very overweight in value theme, because over the last 3 years, whatever surplus money you had, you invested in value, or maybe that has worked very well for you. I think now it is a time, at least you review it. Maybe incrementally you would like to add another theme. It can be, let's say, quality. This is my personal belief that over the next 3 years, I believe that quality should do well. It hasn't done well over the last 3 years. So maybe incrementally you can put money in quality theme. So this can be one approach.
All right. Now with more retail investors entering the markets and DIIs playing a stronger role, do you think Indian markets are less dependent on FIIs now? Also, what does this mean for long-term stability of Indian markets?
So yes, DIIs flows are very strong, and one of the reasons why we have seen very less correction despite this $14 billion outflow by FIIs in quick succession is because of the support given by DI investors. But FIIs are important participant in India. Let's say our market cap is 100 rupees. About 50 rupees is with promoters. The remaining 50 is with DIIs, retail investors, and FIIs. So out of that 50 rupees, which you can say it is a floating market cap. So 50 is the floating market cap, which is getting traded every day. And major participants are FIIs, DIIs, and retail investors. So out of that 50 floating market cap, DIIs still have about 18, which means out of the floating market, they hold about 36% of our floating market. So they are a dominant player. So their action will have implication on our market. So if they are continuous buyer, market will see some positive movement. If they are continuous seller, market will see negative reaction. So yes, they are important, but obviously, as you rightly mentioned, our dependence on FIIs have reduced. Secondly, we can interpret this is like that, okay, because of constant inflow by DIIs, now FIIs flow may not have that kind of market reaction which used to happen 10 years back or 12 years back, 15 years back. So yeah, so it is good. Second, about stability, yes, I do believe that trends are suggesting the way retail investors have behaved, because there was this apprehension that a lot of investors came to the market after COVID, so they haven't seen any correction. First of all, it is not right. In fact, in the month of June 2022, markets have corrected almost 15% from their peak because of Russia-Ukraine war, etc. FIIs have withdrawn some $35 billion at that point of time also. Then in the month of March 23 also, we have seen about 10-12% drawdown in the market. And recently also, we have seen about 10% drawdown in broader market, and as we discussed, about 25 to 30% drawdown in some of the sectors also. Despite this, we have seen continuous increase in SIP flow month on month. So I don't buy this narrative that these are rookie people, they don't know anything, and after seeing first correction, they will start redeeming everything, they will panic. I don't believe in this thing. because market have seen some drawdown. Having said that, how these people will react, new investors will react after the, let's say, 30% correction, that I don't know. But I can tell you that we can see some stability, and a lot of youngsters are coming in equity market. They have a very high risk appetite as compared to somebody who is into 50s versus somebody who's into 20s. They have a high risk appetite. So I want to believe that even after 15-20% correction, we may not see that kind of panic which people are anticipating. So yes, I believe that this will increase stability, but we should know that higher stability doesn't mean that we will never see minus 10, minus 20, minus 30% in equity market. That can happen at any point of time. Some black swan event will take place, which we can't discuss at this point of time, and we will see market correcting by 20-30%. But market correcting by 60-70%, like what happened in global financial crisis, that looks very odd at this point of time because of the constant flows by the DIIs and the kind of awareness now people have because of the social media network, and now people understand that equity market is volatile. There will be days, there will be years when market will not do well. So yeah, this is my view.
All right, on that positive note, let's wrap up today's conversation. Thank you, Manuj, for joining us. Thank you for the insights.
Thank you so much, Rishi, for calling me.
Thanks.